Good morning. This is the ARMR Report, our week in review. I'm Brett Rosenthal. I appreciate you all joining me on a Saturday after a crazy week in the stock market to get us all ready for next week. That's the purpose of today. It's the ARMR Report. It stands for Algorithmic Risk Management Research. So we begin and end our process of investing by protecting capital first, then we capture upside. This is why ARMR portfolios are making money this year while the market is suffering. It's because we start by protecting capital, and I'm going to share with you the process of how we do it. We've been doing it over 30 years. It's a basic three-step process, getting rid of all the noise out there. We do research, fundamental research. We put those names on the whiteboard and continue to follow them, getting ready to invest. We use ARMR algorithms to let us know when to commit capital, when to protect it, and we use stop losses to protect ourselves from ourselves. And when you put those three pieces together, you're able to navigate any market environment, and you're able to see over time net worth grow without dramatic drawdowns. All right. So today what we're going to do is break this down into 4 segments. We're going to talk about our ARMR risk monitor. And if you look at the ARMR report right here, you'll see right here, there's 4 tiles. The risk monitor right here, we update that every time we see a change in our 7 algorithms designed to follow the top 7 indexes that drive all of our risk decision. The S&P, the Dow, the Nasdaq, the small cap, the momentum, the value, and the IBD 50. When those 7 give us a direction all at the same time with confluence, it's very important we follow, whether it's protecting capital or capturing upside. All right, then what we're going to do, so we're going to look at those algos and see where are we now. We know they're risk monitor red. It's been red really since December 3rd with an occasional try at changing color, but it doesn't go anywhere. So it's been red since December 3rd, and we'll go over that. And what could happen next week that'll change that, okay? Then what we're going to do is drop down into a discussion of how to create bear market alpha. How are we doing it at the ARMR report? How are we making money while the market is suffering dramatically? We're going to go over our top investment themes that we're focused on. Precious metals, energy, uranium. We break out of the energy space. I know that's energy too, but they're separate stocks. They trade on their own. And agriculture. We have to talk about that today. All right. Then we'll break it down. We're going to look at, I think it's maybe 5 or 6 stocks I want to show you that are at the very top of our whiteboard for immediate consideration. We may be adding them to the portfolio next week, and I'll go over with you each one. 2 of them are dividend stocks. So the ARMR report has 4 portfolios we manage that we share with insiders through our portfolio screen and our spreadsheet. One is a kind of a blended approach. We call it ARMR 1. It's got indexes, it's got day trading, it's got really whiteboard focused, fundamentally driven stocks that we put into the portfolio when the risk monitor tells us the window's open. Then we have our ARMR 2, which is designed to really day trade and swing trade indexes and ETFs. We don't buy individual stocks. And then we have our dividend portfolio, which we run with completely different disciplines. And we round it out with an index-only portfolio that literally follows the risk monitor step by step. Risk monitor red, 100% cash. Risk monitor green, all 7 indexes are long. Those 4 disciplines create, I should say it's one way to manage risk, right? To create different styles of management. There's no such thing as buying bonds and stocks and hoping that protects you. We're in a world of almost 100% correlation. So bonds are going down, stocks are going down. You're not getting any protection by splitting your portfolio 60-40, right? You don't get protection by buying stocks all over. Oh, I'll buy, emerging market stocks. That'll help me with my domestic. No, it won't. They all go down together. What will help you is different styles of management. So we'll go over that too. All right. And then what we're going to do is I'm going to share with you just some thoughts on really how to manage risk in this environment. There's 3 steps that I'm going to walk you through that I think are very important to managing risk and still capturing upside. and then I'll get to your questions. Don't forget to fill up that question board if you got thoughts or questions along the way, and we'll get to all of those questions. All right, let's get down to cases here. Don't forget, whatever I share with you is information I use personally to invest. So you got to figure out your own risk tolerance, make your own decisions there, use your own due diligence. Okay, so I'm just giving you thoughts to stimulate your mind, and then you execute what works for you. You can always subscribe to the YouTube channel right down here. And of course, the ARMR report. Consider subscribing as well to the ARMR report. Right in here at the top of the ARMR report, you're going to see this free link here. You click on the action alerts, ARMR action alerts. And what you're going to get every morning is an email letting you know how we're approaching the day from a day trading and a swing trading / investing point of view before the bell rings. And you'll get a replay of our morning meeting. Okay, so it's free. Go ahead and subscribe there if you'd like. Don't forget the like button helps me out. So go ahead and smash that whenever you think you've enjoyed something that I'm talking about. All right, let's begin by looking at the risk monitor and saying, okay, big picture it. What's the market look like? And I wanted to start with a picture of Tesla. Tesla's been driving the bus for a long time during the bull market. Tesla represents a large percentage of the big indexes. Okay. And so we've used Tesla for months now as lead indicators in our day trading techniques. And it also works here with the big picture. So what you want to see here is a massive uptrend in Tesla since the beginning. All right. Since the beginning of this bull market. Here it is, uptrending channel. And it would be really a dereliction of duty not to recognize and discuss with you all that Tesla is in the process of breaking down from a major top. So keep your eye on Tesla. This is a downward sloping breakdown, just happened on Friday. If it takes out these lows, it continues to lead the indexes. What you don't want to see is Tesla implode. And unfortunately, I think what I would say right now is this market will bottom probably when Tesla does implode. When names like Tesla are given up on and puked out, that's when you're close to the bottom. So let me go back to saying what I said a few weeks ago. This is not a market to bottom fish. The risk monitor's red. Let's go look at the indexes real quick. Okay, let's go to the S&P. You can see the pattern looks very similar, okay, to Tesla. A whole new structure has to form before you would see a significant risk monitor change. Now, let me explain that. We have 7 indexes. The algorithms tell me what to do. When they all line up and tell me the same thing, I act. So I think it was 2 weeks ago, we had risk monitor green for a day. That happens in a bear market. If you recall, I wrote to you and I discussed it on this call that Saturday, that when we get a risk monitor green in a bear market, it happens. In 2008, it happened 4 times. Statistically speaking, risk monitor greens that fail within the first week are a paw print of a bear market. So this brings me up to a point I want to share with you all. It's very important, particularly when you're day trading. When a stop is hit, the emotional response is disappointment. But what the real response should be is, I've just gotten a golden piece of information. When it comes to the risk monitor, I've learned this over years of using the monitor. Statistically speaking, when we get a risk monitor green signal, markets are higher in the following weeks, roughly 90% of the time in a bull market. Probably drops to about 70% of the time in a bear market. There aren't that many bears. We can go back and look at them. So there are some bear market rallies that work. In a crisis year like 2008, 4 for 4 hit their stop within a week. The information we get from that is that we're in a serious bear market and you can't lose sight of what's unfolding. That's what I want to share with you today. So we're risk monitor red. It happened last week. I told you that last bit. It's really important to understand when a stock gets hit, what's it telling you? If statistically speaking, 8 out of 10 times the risk monitor goes green and we're able to make money, and this is one of those 2 times we can't, it tells you the market's going a lot lower. That's what it tells you. Okay, so when we take this big picture look, and let's just go look at a couple more charts here. Let's look at the Nasdaq 100. All right, they all look pretty much the same, right? Just total breakdowns that look god awful. Nasdaq's down something like 20%. Okay, the momentum index, just an implosion. Remember, we talked about this rising wedge, bearish rising wedge. Right in here, I said to you guys, something's very wrong with the market. This was in December. We were risk monitor red. The market's imploded since then. Okay, and of course, we keep monitoring the bond market. And this is the real problem. Remember this pattern? Remember this chart? Don't forget this here. Okay, the breakdown last February killed the innovator stocks. And I shared with you back here in December, the breakdown in LQD, which is corporate investment grade, is going to kill the Nasdaq 100. Do you all remember that conversation? I shared it with you on a Saturday just like this. I said the risk monitor's red. And corporate investment grades breaking down. The first time it broke down, it killed innovator stocks. This time it's going to kill the NASDAQ. The NASDAQ has dropped 20% since that video. Okay? So the question we have now, we already exited where we should have exited. This is why ARMR portfolios are up on the year. This is why our alpha is going like this as the markets implode. I think the S&P is down 12%, okay, for the year, right? ARMR portfolio is like a balanced portfolio. ARMR is up about 5-6%, okay? So what do we do from here? There's nothing close right now to the risk monitor turning green, but we do have a key FOMC meeting next week. So I just wanted to share this thought with you before we go on to the next discussion about how to build alpha in a bear market. The risk monitor is still red. We're in a negative gamma environment. Now, you know at the ARMR report, we do follow spot gamma, and we use spot gamma as our source for understanding options flows. Now, option flows can't overwhelm a nasty bear market. We have geopolitical events going on. There's all kinds of things that are overwhelming typical options behavior. Example, usually in front of Friday, a weekend, you will see puts get sold after a big down week. Puts get sold, and at some point on Friday, the market lifts. It's just natural. It happens almost every Friday, even in the bear market. But this Friday, it got pummeled. People were piling into puts. So the typical behavior is not unfolding. However, next week's the FOMC meeting. Once you get past that, there's going to be wild swings in the market. So get ready for these thoughts. You might want to write them down so when you see it happening, you can try to, at least you'll be able to understand what's going on. If the Fed says we're putting our rate hikes on hold, we're not going to remove liquidity from the system because there's liquidity shocks because of the Eastern European war, chances are the equity market goes through the roof. At the end of the day, don't forget, the bear market started not because of Russia and Ukraine, but because the Fed's reducing liquidity and raising rates. So if the Fed doesn't do that, the knee-jerk reaction will be to rip the market higher. And don't forget, in bear markets, historically, if you look over time, the largest two-day rallies happen in bear markets. The largest one-day rally happens in bear markets. It's so important that you turn off CNBC and et al. Okay, none of those financial news networks are going to help you protect your capital and make money, particularly at a time like this. They are constantly cheerleading. I saw a headline last week in the middle of the market implosion. There was one big up day in the market. And what they talked about breathlessly on CNBC was, this is the biggest one-day increase in the S&P since 2020. But what they failed to share with you is that's a paw print of a bear market. Because bear markets, just go look through history. The biggest 1 and 2 day rallies happen in bear markets. So instead of trying to get people excited and get people to buy the bottom, what they should have been telling you on CNBC, and they never will, is this is a bear paw print, and you need to use this huge up day to reduce your exposure. Okay? So wrapping up this thought on next week's action. Should the Fed put things on hold? Should the Fed shift and say, we're going to add liquidity to the system? My guess is the market's going to be up huge, and it will be a tradable rally that we will be after on the ARMR Report trading desk. Now, the weird thing is you might think that's going to have a negative impact on maybe gold and silver and some of these commodity names. My guess is there might be a knee-jerk reaction that's negative, but by the end of the week, those assets should be up huge because we have a major inflation problem. And if the Fed doesn't raise rates and reduce liquidity, it's going to get completely out of hand. So any weakness in the commodity names on the back of that type of story is an opportunity to add to positions. All right, so that's the big picture on the market and the risk monitor. Let's shift over now to a discussion on how to create alpha. What are we doing in this market right now? We're focused on precious metals, energy, uranium, and we're going to focus on agriculture. So let's just go run through a couple of chart patterns. Let's start with gold and silver, okay? And let's go look at the weekly charts, because what's happened here is you've had a blowout off of this downtrend, which we were expecting. We're long in here at the ARMR Report, okay? Runs right up to the 4th standard deviation above the 200-day, which is usually telling you it's a little bit tired and it's going to have to do some consolidation, okay? Which is what happened over the last couple of trading sessions. Went up here and then came down and consolidated a bit. And could even come down more and create a base down here. Nothing wrong with that. I think it's important to look at the big picture on precious metals, and that's what you want to see. The weekly chart pattern is a massive breakout, and there's a lot of upside left to be had in precious metals. Doesn't mean there can't be some weakness, Fed comments, whatever. That will create a buying opportunity in the metals. Here's silver. Silver hasn't even, I guess I got to say it started. We bought it down here, and it certainly got started. But the real breakout in silver, this is Sprott physical now, is above 10 on Sprott physical. It's not even there yet. Let me go over Sprott physical for a second. We believe we're going into I've been saying this since the start of the year. This is the commodity super cycle of 2022. We think it's going to result in massive upside in precious metals. We do not want to own ETFs that don't actually own the metal. If things get crazy enough on the upside, there'll be a point at which people realize that GLD and SLV don't really own the metal. And there'll be a premium that goes into Sprott funds that have the bars, serial numbers counted, audited 4 times a year, sitting in a vault. And the units that you own give you a right on those bars. If you hold them for 12 months, you could get delivery if you want. That's going to have value. So mark my words, before this is over, these funds right now trade at a discount, or they trade somewhere close to NAV. You're going to see them trade at a premium. So that's why we focus there. We also enjoy the Sprott funds, and we've focused here. Now, I want you to look at this chart, and I think what you really want to do is, and I'm going to go to the daily for a second here. This is a Sprott physical uranium. What you want to do is print up this chart and put it above your desk as a trader, as an investor. You will never see a more delicious pennant than this right here. And we were buying that green box on the ARMR trading desk right there. Okay? So we're creating alpha by focusing on hard assets, by focusing on precious metals. Of course, we have our top 4 precious metal stocks. These are Barrick. And let's go back again. I think it's so important you guys look at the weekly, because we can get lost in the daily patterns and the daily fluctuations and think there's something maybe wrong because they're down for a day. These are big time breakouts that are just getting underway. And, you know, my favorite leader here has got to be Newmont. That's a sick rectangular breakout of a chart. Newmont, Barrick, these guys, when we were buying them down here, were paying a 3.5% dividend yield backed by gold, with a plan to increase the dividend all year long. So I don't have them in my dividend portfolio, but I probably should. I treat them more like other investments, but I should probably treat them like dividends. Let's go back to Sprott for a second. If you look at what Sprott's doing, Sprott investment firm is putting together these hard asset trusts that are gathering a lot of asset. If there's ever a time for an investment in Sprott, it's right now, in our opinion, when it comes to Sprott as a company. The symbol is SII. This is a bit of a dislocated cup and handle, but there's the cup, and the market got wrecked and it came in, and here's the reversal. Last week was the entry point. This week we're enjoying the ride, but really it hasn't even started yet. It comes out above these tops here, and Sprott itself as an investment company, there's a lot of upside left in Sprott. It hasn't even broken out yet. Now, it's not a very liquid stock, so be careful, but that's also going to play in our favor when it starts to go. So this is an asset gathering financial company. It's just they're in the sweet spot of the 2020 commodity supercycle. Okay, so these are some of the ways that we're building alpha in a bear market. Our favorite uranium plays, UROY. Okay, there's many different ways to play uranium. Our favorite uranium plays are UROY and UUUU. Okay, and then the third play has got to be CCJ. Okay, but the reason I really like UUUU, first of all, let me go over it this way. It's very hard to know what's going to happen next in Eastern Europe. So these are very volatile stocks. You cannot get over your skis in these stocks. Who knows? There's a kumbaya moment and everyone decides to cease fire and go back to normal. These things all get wrecked. So you to a certain extent, you're investing in these stocks and you're at the mercy of headlines. So that's very difficult, and you've got to manage your risk there. Now, having said that, I think no matter what happens in Eastern, let's say the war's over next week, they're going to hammer probably these uranium stocks. But big picture, I think that what's happened over in Eastern Europe is going to shift. There's already a shift going on where takers of uranium are signing long-term contracts at higher rates. So the companies with inventory, Chemico and Energy Fuels, those are the two guys with the most inventory, are going to experience a blowout in their business. So short term, there could be weakness if there's talk of, resolution. But bigger picture, I think this has woken up the fear in takers of uranium supply that they have to contract out and make sure they've got access. That's going to play well for these companies all year. So what you want to do is have a core position on these names and then trade around the core. Weakness on headlines of whatever that brings them down to bases. You want to look to buy it. Explosions on terrible headlines that rip them higher. You want to book some profit. You want to trade around the core of these names. But these are the ways we're building alpha. Now let's shift into the whiteboard because I want to talk about agriculture. There was a question, a couple guys. So first of all, we owned a little bit of IPI. Some ARMR insiders actually still own it. I got off of it way early, got shaken out of it and did not enjoy any of that ride. But on the day trading and ARMR Pro live trading desk, shared that entry point. And some guys are long. Some ARMR insiders are long, and I love that you guys are making money in it, okay? What's happening with potash and these types of fertilizers, obviously, is the whole Belarusian situation, which dominates fertilizers, and you're having these problems. So people who are asking me now about buying fertilizers, I want to warn you. It's like people who were used to ask me back in late 2020, should they be buying crypto? Should they be buying innovator stocks? January of 2020. Well, yeah, I mean, you could. They went up a little bit more, right? And then it was over and they crashed. So there's no way I'm buying fertilizer stocks that are already in the stratosphere because of news headlines out of Eastern Europe. ARMR stands for Algorithmic Risk Management Research. There is no way to manage that risk if you're buying potash stocks now. That trade had to be made already. And quite frankly, if I owned it right now, I'd be booking some profits up here. But what can we do? What's the bigger picture here? The bigger picture is food prices are going through the roof. Farmland here in the US and in other, Canada, whatnot, is becoming more valuable than ever. So let's go look at a couple charts at the top of our whiteboard for purchase next week. I'm not chasing these names, but these names wake me up to the fact that I've got to get agriculture into the ARMR portfolios. And this is the 3 favorite ways to do it. Grab a pen and a piece of paper, write this down. Deer. Got to own deer. That's like a no-brainer chart pattern right there. Huge pennant. Broke out last week, even though it was a down week. Okay? We're going to want to add shares of deer. Okay? Caterpillar. I don't understand how you could possibly have a massive bull market in commodities for the year 2022, and the guy who pushes around most commodities, stock doesn't respond. All the bad news is in it. That's why the stock sold off. Now, here's the problem with these manufacturers. Okay? Prices for raw materials are going up faster than Deere and Caterpillar can produce tractors to sell. So their backlog is ballooning, costs are going up, and you're not going to see the benefits of that earnings and revenue probably till further out. And that's why the stocks have been subdued. But at some point, institutions are going to discount that and say, look at what's going to happen to the earnings and revenues companies. We got to get long these things now. So these are stocks to put on the top of the whiteboard to try to work into positions and start making money of them before they explode. Okay? Here's another name, AGCO. Just like deer. Just like deer. Beautiful patterns. The time to buy IPI was right in here in its beautiful pattern before it exploded. Okay? So now what we're looking for are patterns like that haven't exploded yet. Here it is. AGCO, Deere, Caterpillar. All right. I want to just comment on CCJ real quick. In case you don't own it yet, in case I'm thinking, I don't own it right now. I'm thinking of adding it back to the portfolio. The reason I've been avoiding it is that Cameco has a large exposure to Kazakhstan, and I assume that's gone from them. I'm assuming right now that if this continues in Eastern Europe, that Kazakhstan property is done for them. So it's kind of kept me out. So how do I own the stock when I think there'll be an announcement that Kazakhstan's nationalizing the uranium mines? Okay. But I do think what happens is the sum of the parts will explode the stock higher because CCJ has the largest inventory of uranium sitting there. And if you shut down the Kazakhstan mine, their inventory is going to go berserk. And of course, they have other properties that they'll start ramping up. So I'm starting to believe that if I'm going to invest in uranium, I've got to own CCJ along with my other favorite names. Okay. Before I wrap up here, I know I'm going a little bit late, but a couple more thoughts for you if you guys are enjoying it. 2 dividend stocks I want to share with you. All right. I like to buy dividend. Let me explain what I like to do. All right. I like to buy when I have a dividend portfolio. I have a list of names on my whiteboard. And what I look for is extreme weakness in the company, driving the stock down, yield up. I then continue to do the research. If I'm comfortable with the investment idea, that's the time to own it. Because I can capture principal appreciation and a ridiculously high yield for a long period of time. So I'll put a position on. I use a weekly stop. I don't pay attention to the stock market or the risk monitor. I put a position on. I use a stop for a weekly stop. So if it goes below the stop during the week, I have to suffer more losses. I'm not selling it till the end of the week, and it proves it's below the stop. Okay? So it's a different style of management. But these are 2 names at the top of my list. I haven't added yet, but I'm very close to pulling the trigger here because I just don't see how I can miss on these names. The first is AT&T. I've avoided this entire decline in AT&T. I get it. Everybody thinks AT&T is going to cut the dividend. You heard it here first. This is an 8+% yield, and you heard it here first. If AT&T actually announces a dividend cut, I submit to you, number one, it won't be the only thing they announce. They'll announce a restructuring package. Number two, everybody already expects them to cut the dividend. So the day they announce it, it may be down that day in a knee-jerk reaction. I bet by the end of the week, the stock is trading higher. Because number three, institutions, anybody short AT&T covers once they cut the dividend. Okay, I don't know who would be short AT&T, but I'm sure there are some people, and they'll cover when the dividend's cut. And institutions who are watching what they're doing and understand their restructure will support the stock. I've seen that happen over and over again on a big company that eventually cuts the dividend. The stock actually goes up. So we're at a juncture here in AT&T at an 8% yield. To me, it's like a win-win. They cut the dividend. I don't see a lot of downside. They maintain the dividend and somehow work themselves out of the hole they're in, and I get to collect 8+% yield. I've made money on AT&T multiple times in my life doing this exact same thing. What was it? Was the debt this bad? I mean, no, it was different other times. But it's the exact same play, and I've done it over and over again, and I'm going to do it again in AT&T with an 8% yield. Now, my stop is going to be a weekly stop below these lows. All right, and I'll take this off so you can see it. Below these lows will be my weekly stop. As long as it stays above those lows, I stay with the stock. Okay, you don't chase AT&T. When it was running like this, I had a lot of people asking me, should I be buying AT&T? Not when it's running. Then it gets wrecked and nobody wants to own it, but that's the time to buy it. Moving on. OHI, I've been doing research on this, okay? I've been following OHI for a long time. Stock's got a 9% yield. It's a real estate investment trust focused on long-term care, which is going through a 100-year storm right now because of the pandemic. There's massive backlog. In other words, a lot of patients want to get into long-term care, and they can't do it because of the pandemic. The inability to hire nurses is constraining the business because of the pandemic. All the bad news is in it now. This is a real estate investment trust. You know the 3 best areas to invest in a bear market based on inflation during the 1970s? The 3 best places to invest: precious metals, energy, and real estate investment trusts, because they own property. The worst thing that happens here for OHI when a tenant goes bankrupt, which is happening because of the pandemic, they get the property. They have the property. They release it to a new company that's well capitalized that can start paying rent, or they sell the property, which has gone up in value. Management says they can continue to fund the dividend. They don't see the need to cut it. Now, look, there's another pandemic. If this thing gets worse, sure, they might have to cut it. But right now, they're not cutting it. It's a 9% yield. And I think all the bad news is in it. The time to buy dividend stocks for a dividend investor is when the stocks have been crushed. They set up a bottom. And let's go look at the chart, right? It's a pretty obvious double bottom right here on the chart. So I go to the weekly chart and I say, here's my weekly stop, right? We take out these lows and I'll say, maybe I'm wrong on this decision. But if it starts creeping higher like this, I've locked in a 9% yield in a quality company. This is not a REIT with only 10 tenants. They have hundreds of tenants. A certain percentage are going to go bankrupt. It's happening. This is the worst possible environment for long-term care, which, by the way, has a significant growth trajectory, right? Because a lot of people are getting old and need long-term care. The demand is there. We come out of this pandemic and they're able to right the ship. And this is like a no-brainer. I look back on this 12 months, the stock's up 30% and I'm collecting 9% yield. If I don't do it and stock's up 30%, I say, how can I miss that yield? So I put the position on, I use a stop, and I see if this is the right entry point. That's how I build my my portfolio of dividend stocks. Now I want to round out this conversation with the last thing here about how to make money, how to manage risk in a bear market. There's three things I want you to focus on. This is what we're doing on our trading desk. I think it's very important. Number one, always maintain a cash position when you go to sleep. This is not a market to be on margin. It's not a market to be fully invested. It's not a market to be greedy. Okay? Number two, I want to make this clear. We were talking about this on the trading desk this week, and I want to share it with all of you who tune in on the weekends. We have a 100% commodity-driven investment portfolio. This is why we're creating alpha this year. But that means that our flank that's at risk is a market that goes up because of positive developments, whether with the Fed or Eastern Europe. They wreck commodity stocks and the S&P and the Nasdaq go through the roof. So the hedge for that portfolio is actually a long position on the S&P and the Nasdaq. Don't make the mistake of using VIX to hedge a commodity portfolio. VIX and commodities go in the same direction. And I just wanted to share that with you. Adding VIX to a portfolio full of gold, silver, uranium, agriculture, energy increases your risk. Because the real risk to that portfolio are positive Fed announcements and positive announcements out of Eastern Europe. So what we did this week is we went to bed one night, it was Thursday, long the S&P, not because we had a risk monitor buy signal, but because we were using the S&P to hedge our commodity portfolio. Market gapped up 1%. We booked a profit on it. That was the hedge. Then the market rolled over and imploded. So I'm not holding the S&P. I use it at night sometimes, at the end of the day, to hedge the portfolio. I did not do it on Friday. It looks like the market's going to, to me, it looks like the market's going to implode Monday. So I'm not hedged at the moment. But I use it to hedge on occasion. So don't forget that. When you're trying to hedge your portfolio, make sure you're using an asset that actually hedges what you own. All right? And then the third thing to do is to day trade the indexes. There is a significant amount of alpha you can capture day trading the indexes. We do it every day on the ARMR Pro live trading desk. I share the screen. I walk you through what we're doing. You learn step by step how to do it. I suggest you join us. Let's get to the Q&A, guys. What do you got for me? Thanks for spending your time with me this morning. All right. Oh, you know what I wanted to do? I wanted to share this with you. This is the first thing I want to talk about. I'm keeping a promise that I made to all of you at the end of February of 2020. I kept that promise in the last 30 minutes of trading yesterday. Let me tell you what that promise is. When you're in a risk monitor red, negative gamma environment, you must adhere to swing trading tactics. Now is not the time to plunge in long, I don't care what the asset, and hold on for dear life. There's never a time to be a holder like that, but particularly not a time like this. Headline risk is extreme. So what we do at the ARMR report is we have a spreadsheet. I show you where I buy, the price that I paid for something, what my stop's going to be, and my target. And I promised you after February 2020 that the next time we were in this situation where we're making a killing and outperforming the market and our assets rip up to our targets, I will book profits. I don't care what you book. 5%, 10% of the position, 25% of the position. I don't care what it is. You book a profit, you raise your stop, you take emotion out of the equation. So while I'm excited about what's going on in the portfolio, and while I say to you, this is the most unbelievable chart pattern, and we captured it right at the beginning. Okay? This is the uranium. I'll use it as an example. The target on physical uranium was right up here. That's our original target. We reached it, and I booked a partial profit in the last half hour of trading yesterday. I booked a partial profit in HP yesterday. The target was the fourth standard deviation above the 200-day. We bought it here. It ripped to here. We book a partial profit. I'm not saying to sell it all. I think they can go a lot higher. But what I am telling you is this. At the end of February last year, I gave back way too much of my gains in the innovator stocks. And I promised you I would never do that again. Right now, I'm keeping the promise. I think commodities are going a lot higher. Okay? I think there's massive upside out there. But when asset hits a target, I book a profit. I raise my stop to at the very least, you raise your stop to break even. So guess what? I'm going to get paid no matter what happens now. Comes back to break even, I'm out, and I booked a profit right near the highs. Continues to skyrocket, I keep making money. Maybe I booked 25% of my gains. Okay, so what? I got 75% of the position on, and I keep making money. And emotion's taken out of it. And now guess what I can do? I get to trade around the core. When the asset comes down for a couple days, there's a positive story here, or the Fed says something and commodity stocks get whacked. I can go put those positions back on at the correct entry points. And I'm going to trade commodities all year because I think it's a commodity super cycle. So I'm trading around the core. I promised you I would do it after the collapse of innovators, February 2020. It's not easy to do. The psychology of trading is more difficult than any other aspect of trading. I can tell you where to buy stocks. I can use algorithms to help you understand now's the time to take risk. Now's the time to take risk off. I can show you how to buy weakness in the midst of strength, and you'll get all of it. As an insider, you're going to learn it, and you're going to start doing it, and you're going to say, wow, this really works. And I can tell you right now, the hardest thing for you to learn, and something I keep working on myself, is the psychology of trading. When assets are going through the roof in your portfolio and you're just having huge alpha success, the emotion is greed. You want more and more and more and more. And that leads to heartbreak. And that leads you further and further away from managing risk. And so we have a spreadsheet set up. When we hit a target, we book some profit and raise our stop. If the asset keeps running, we keep making money. And we don't look back and say, oh, I shouldn't have sold it. No, we should have sold it. We should. Guess what? The asset could keep going and make a high tight pennant, and I might buy it back and raise my stop to the low of the pennant and have it explode again. There'll be opportunities to trade around the core. But we've got to be disciplined. That's my thought for you. Now let's go to your questions. How late is Exxon? Too late for Exxon? Low enough Facebook? Too late for Amazon? Curious. All right, let's go look at them. Exxon. ARMR report added Exxon in that green box right here. And what I would never do is tell anyone to buy an asset that's all the way up here now. Okay. So let's look at Exxon from a trading around the core standpoint. Exxon went right up here and touched the 4th standard deviation line. So there's a point where you would book a profit. Notice how it pulled back to the 25-day moving average, set up a pennant. You could buy the asset back right here and raise your stop to the low of the pennant and enjoy the next run. That's something we might do in an idea like HP. We book a profit here. We watch it build a base. When it breaks out of that base, we could double our position and raise our stop to the low of the base. Sorry to get off your questions, but that's how we're going to do it. Anyway, so no on the Exxon for me. Amazon, let me just say about stock splits. Stock splits are never a reason to go buy the stock by themselves. They're a good bonus. You know, it's kind of nice, but I don't just buy a stock because they're splitting. So that's my first thought. So I'm just going to go look at the chart. I mean, Amazon has been building a huge base. It's been underperforming the market on the way up. It's maybe outperforming the market a bit on the way down. It could be a double bottom, but there's nothing there for me to do at the moment on Amazon. So if you like the business model and you're, you want to be there, if it's on your whiteboard, it's not on my whiteboard, but if it was on your whiteboard, at the very least, it would have to break back above the 50-day moving average before I would add it. That's my personal opinion, which is, I think, what you're asking me. Facebook is completely dead. I wouldn't touch the stock with a 10-foot pole. I mean, I wouldn't touch the stock if it was in the metaverse and I was wearing, an Oculus. That looks god-awful. And the amount of people and the amount of money trapped in Facebook at these levels is going to make for overhead supply that's going to keep the stock down for months. So even when it builds a base, it's going to have to be a 6-month base to work out all of the people trapped up here. So there's no way I'm doing that. Hey, Deb, how are you? Nice to see you. Okay, KHC. Craft Hines. Ooh. All right. So, we had an ARMR Insider come up with a great REIT idea on Friday, PECO. We don't own it yet, but this is a REIT that owns plazas where large grocery store chains are. KHC. So this is I'm not buying it right now, but that's a 3% yield on a really interesting REIT. KFC. We have another ARMR Insider who has been pounding the table on Kroger and made a ton of money on Kroger. Hats off to Pac for just killing it. And thanks for sharing that on the ARMR trading desk for everybody that, participate in if they wanted. Look at that cup and handle you captured. Well done. So I bring this up because, Deb, KHC, these are safety stocks. These are places people go to, to hide money. The chart certainly looks good. So It really comes back to the portfolio you're trying to build and understand what it is that you're doing. So for me, before I would buy Heinz, I'd rather carry cash overnight and day trade the indexes. What I'm carrying overnight are commodities. If I were to have commodities and all of the positions like Heinz, when good news comes out of Eastern Europe and the Fed decides not to raise rates, Heinz is going to get crushed like all the other commodity stocks because it'll be a place that money leaves in order to go buy tech names. So I don't want to overweight my portfolio. I have to choose what I want to own. Heinz doesn't make it, but the chart certainly looks good. So if you're asking about a chart pattern, and I don't know your portfolio. So if this is your way to hide some capital, I mean, have at it. There's nothing wrong with that pattern. That looks god awful. I couldn't trust that. I mean, there's no way I would touch that. Don't forget, Deb, I don't ever like to catch a falling knife. So we need higher lows and higher highs to start searching for a bottom, and there's no bottom in sight on Starbucks. Ross Stores, I don't see anything there either. Don't forget, on these multi-international retail companies, they are faced with a horrible situation of having to shut down all of their business in Russia. The street might be concerned they'll have to shut down business in China at some point. So multinationals right now, to me, are not attractive investments. I'm much more attracted by, for instance, PECO, retail REIT of grocery stores here in the U.S. Boy, I like that idea. In a bear market that's based on inflation, I want real estate investment trusts. I want real estate. I want it here in the U.S. Things like that is where I'd rather go. How long do you think commodities will run? Cooling off. PDBC. I have to look into that. I don't know that one, so I can't really comment on it. I don't know what they've got there, why it gapped down so aggressively, and why it's running now. So I'll get back to that. Equity income. Nothing wrong with that pattern. So you're asking me, when will commodities cool off? Again, I thought this would be a commodity super cycle for the entire year of 2022, and I said that early January. I didn't know there'd be an Eastern European war that's just lit a fire under these things. I can't even begin to predict when it's going to cool down. What would it look like? I guess at this stage, I'd be looking for major reversals, inside out weeks. I mean, like huge up start of the week, huge down at the end of the week, big doji stones, candlestick kind of reversals. And that wouldn't kill the story to me. It would just tell me, all right, they're a little overdone. They need a few weeks to consolidate before they rip higher again, is my point. Okay, so I'm a big fan of RIG. It went right up to its target right up here. I've booked a profit right now. I took it off the table completely. I reduced positions in an HP. All right. I can't wait to buy them back, JJ. I just personally, at the end of the day, Friday, the way the market was trading, my realization that we're making a killing on energy and all these stocks that are in ARMR portfolios. Unfortunately, had these been going up based on a normal environment where the Fed was raising rates and inflation was getting out of hand, I would be more apt to leave the positions alone and not trade them. But I do recognize that we are completely at the whim of headlines out of Eastern Europe, and I cannot be over my skis there. I'll take a very good first couple months of the year, and it will be wiped out in 48 hours if I'm too aggressive. You got to manage risk in this market. So I love those three names. I really love TEL. We made some money day trading TEL yesterday. This was a day trading opportunity on TEL yesterday. This is our day trading screen. You guys have seen it before. So what we look for are pennant type of formations in the morning, which we got right here on TEL, just to show you what we did here, right near the ARMR moving average, which is this yellow line. This is our favorite type of day trade. And it really worked well last week. So we were all over TEL right in here, and it popped up and took off. I didn't hold it though. I booked a profit on it. I'm just not willing to hold it right now. I'm very, very uncomfortable with the market. I'm concerned of two things. Number one, on a positive note, something comes out of Eastern Europe. That would be great for the world community and terrible for a portfolio full of commodity stocks. So I can't be overloaded there. And then the other thing is, if the selling gets ugly enough, I believe there's going to be a morning. I really believe this. There's going to be a morning where the market opens down 5%. That's where I think this is going. And when that happens, they're going to sell everything. I mean, maybe gold and silver stock, physical gold and silver, physical uranium. Those things might be up that day. Physical energy, if you can't really own physical energy, but you know what I mean? Like, possibly the price of oil and gas, the price of uranium, the price of gold and silver will go through the roof on that day. But when the stock market implodes, it drags everything down. People just start dumping. It doesn't make a difference what the company does. And that really concerns me. I've seen that many times. So I can't be, I'm holding gold and silver stocks, mining companies. I'm holding energy companies, primarily the pipelines, because I can live through the swings and keep collecting 7% yield. That's a no-brainer to me. But I can't be overextended. So, by the way, when we get that 5% gap down, that to me will be close to a bottom. We need that capitulation, complete, implosion, fear through the roof type stuff. And the ARMR report's going to have tons of cash. We're going to be banking out on our physical metals on that day, I hope. And we're going to be looking to start buying the S&P and the Nasdaq indexes, capturing the alpha. But anyway, I love those three names, JJ. So they're at the top of my list to keep trading and own. Lithium. Oops. I don't own any lithium plays. You've got to make sure you know where the asset is located. Part of the problem with the lithium plays, I'm afraid, and I haven't done enough work on it to speak intelligently on the topic at length. So I'm not going to go into lithium, but I'm just saying where are the mineral deposits, and if they're in parts of the world that are in duress, owning the mining companies is very dangerous. It looks like they're going to nationalize copper in Chile. So copper mining companies are, out of luck. They get their property stolen from them. The stocks underperform. This is a treacherous market. So I lean more towards owning the physical asset. This is why I love Sprott physical funds and Sprott investment company. They started that company literally. It's the perfect storm for Sprott as an investment company. I don't think you're ever going to see a better market environment for SII than you're seeing right now. Hey, Aries, how are you doing, man? Time to revisit Dow. Probably. What's it looking like? And what's the yield on it? Oh, yeah. I'm going to write that one down because that's a dividend payer. Probably at that rate, I bet it's 4.5%. So I'm going to write that down. I have a pen and a piece of paper, and you all should too. So we originally bought it here. Remember that, Aries? And we went up a little bit. We got out of it, and it hasn't been doing much, but it is making higher lows and higher highs, and it's trading above all the moving averages, and chemicals are probably a way to go. Here's the only thing. This reminds me of the trade we were talking about Friday in LEU. Chemical companies take raw materials and convert them into finished goods. If the price of the raw material skyrockets and and you don't have a commensurate increase in the finished goods, or you're not able to get your hands on the asset, does it negatively affect their business? This is something that probably concerns me a little bit. I have to think about that. And what I'm talking about now, for those of you who weren't on the desk, one of the things we do at the ARMR Report is we listen to conference calls together. And we do it because I've been listening to conference calls and managing money for over 30 years. And I try to share with you my process of listening for particular pieces of information and acting when you hear that piece of information. So the only way to get really good at this is to do it over and over and over again. If you're an ARMR Insider, you join us on the live trading desk, and we literally listen to the call together, and I share with you as it's happening what I hear and how I believe it impacts institutional investors. Okay? And so on Friday, Centurus, which is a uranium company that I love, by the way. I think they're, before we had the European situation, LEU was a big idea for us last year. I did all the research on it. I said, boy, I think this is a great idea. It's the future of nuclear energy. It's smaller reactors. It's blah, blah, blah. Okay. But at the very core, when Erez asked me about this last week, no pun intended, at the core. At the core of this company, they are a taker of uranium, and they convert it into a different product, and they sell that second product. So they need supply of uranium. And so this is an idea I'm avoiding. I want to own CCJ. I want to own Energy Fuels. I even want to own UROY, the royalty play, because these guys have the asset and the price of the asset's going through the roof. I want to avoid guys who need the asset to create a product. So on the conference call Friday morning, we were all listening together. And the only thing that mattered on that call, the stock was up something like 13, 14% when we heard this comment. And I'll paraphrase. All of our supply comes from Russia. Maybe he said the majority of our supply, whatever. Their biggest supplier is Russia. And I said at that moment, with the stock up 12, 13%, it cannot be held. You cannot hold a stock where its primary source of raw material is coming out of a country that's in the process of being shut down by the rest of the world. Now, management says that they have other sources they can get to. And I submit to you with all respect, and I mean no disrespect to the management, but that is a pipe dream. If Russia's taken offline and is not able to sell their uranium to the rest of the world, if Kazakhstan goes down, okay, the lineup of big players, nuclear power plants, utilities that are desperate for product are going to be at the front of a very long line that LEU is at the back of, trying to get secondary sources of supply. So you can't own the stock. And I think the stock closed the day down 15% from being up 14, 15% when we heard that on the desk. And I said to you guys, you can't own it. And I know some of you sold it right there, booked a profit, and the stock was down dramatically by the end of the day. Okay, so that's something we do on the live trading desk. And I suggest you join us because we really do it. We try to do it not every day, but we do it on a lot of days. We covered CrowdStrike this week, listening to the conference call, Kratos this week. So over time, I kind of walk you through how I do it, and I think you'll be able to learn the process on your own. And I really encourage all of you to listen to conference calls. Listen to the analyst questions. If you don't get what the CFO's talking about, don't listen to that. Just fast forward to questions from analysts, and they'll tell you what's important and what they're looking for, and you'll learn it over time. So anyway, Dow Chemical, I'm not sure about the chemical stocks. I don't know, but I do like this idea. So let's do some research, and I could be wrong on my concerns there, and Dow could be a great idea. So let's do some work next week. CEA. Okay. Oh no. Okay, like UGRO. I thought you were pulling my leg there, Jersey. No way I'm buying that. UGRO. That's an interesting idea. That's right, because UGRO is not just a cannabis company. The only problem is it's locked into all the cannabis ETFs, and it is a cannabis company. It's viewed as a cannabis company, and so I don't know. It's an interesting thought. I have to put some thought into that. I don't know. ARR. ARMR residential REIT. 14% dividend. Well, obviously there's a reason it's a 14% dividend. And I think ARMR, these guys are located up in Vero Beach, which is near me. And I went and met with the management team of this company some years ago, trying to understand this business. And I just don't have an interest in mortgage back. I think if it's the same company, it's a mortgage company, right? Mortgage back REITs. I can't deal with those investments in adjustable rate fixed mortgage backed security. I just don't ever buy mortgage backed REITs. So, and the reason was I just could not wrap my hands around the accounting. You could just drive a truck through the accounting rules for mortgage backed REITs and how they value things. It's so subjective. I can't figure out what their real assets are worth, and it always keeps me away from it. And if the stock's trading at 14% yield, that tells me there's something wrong with their assets. That's what that tells me. SJT. San Juan Basin Royalty. Oh, well, that's an interesting idea. Oh, yeah, I'm going to write that one down. That's an interesting idea. Thanks for that. That's a good wedge. I know this idea. This is a good idea, actually, in this market, right? I mean, what we're trying to do, SJT, what I'm trying to do is focus on. So this holds a 75% net overriding royalty interest in Southland Royalties leaseholding and royalty interests. So as the price of energy goes higher, this is a royalty company on energy. Ooh, I like that idea. 12% yield. See, normally I wouldn't be interested in this company. I'd rather own the E&P guys. But you see, I'm interested right now in building a portfolio of assets backed by the hard asset and not necessarily the E&P company. Because of what's going on in the world. The value of that royalty stream is probably going through the roof. I like that. That's an interesting idea. I'll take a look at that. HPE. Hewlett Packard. Okay, but why Hewlett? I mean, if you want to make a list of tech companies, and I am doing this, so maybe Deb, I should put that on the list. There are tech companies that I'm putting at the top of my whiteboard, and then I watch how they trade, and I'm waiting for just one of them to go up without me. I'll give you an example of what I mean. I thought this was a great idea. Look at this chart pattern. This chart pattern looked great. All right, let's go back and do it like this. Oh, yeah. Look at Micron, right? It's holding above the 200-day. It's holding above the 50-day. It's making a nice little cup and handle. Semiconductors are imploding, but this is a different business. It's DRAMs. These guys are going to be able to buck the trend of technology stocks that are imploding. Even though it's a Nasdaq 100 name, it's really outperforming. Well, relative strength's going through the roof. I didn't miss anything. So what I submit to you is I need to see a chart pattern like HPE, and I'm going to watch it now to see. Is this going to break out without me? Because if it does, Deb, it'll be the first technology stock in months that broke out without me. So I am making a list of those things. Okay. Like, for instance, I got on the list two of my favorite cybersecurity names. Datadog. I don't want to miss this double bottom. Oh, wait, it just got wrecked on Friday. Blowout earnings, cybersecurity at the top of my list. I thought that might be a double bottom down huge on Friday. This was a great conference call. Okay, and ARMR Insiders, you guys can go. Don't forget to go here. I have the ARMR Fundamental Research page where I highlight for you, what we heard on the conference call and what it means to us. You can always go there. So this is a great idea, great story. I'm watching this. I'd like to own CrowdStrike. We're going to see if it actually goes anywhere. Now, here's one name that actually went up a little bit. Oh, the top of my list is PSTG. Now, we bought it right here, Deb, and we made this money. It gapped up, and we booked our profit right here. And then we bought it again right here on this day, and I booked my gain way too early because I booked a gain, and it kept on going up. So that's great. If it keeps going up and there's finally an innovator stock that starts to go up without me, it'll help me start buying other innovator names. So I'll put HPE on that list. I wanted to share with you something else. I'm just forgetting right now, so I'll move on. Cannabis ready? Oh, I wish it was, man. Cannabis is a small cap. These are small cap stocks, and they can't go up. The small cap index looks like this. Small cap index has to recover. So wouldn't that be great? A safe banking bill. That'd be amazing. Hey, Mo, what's happening, man? Nice to see you. EXE is definitely on my list. It's holding up great. So we are building a whiteboard of technology names I want to own if we get a risk monitor green signal. EXE is on the list. CrowdStrike's on the list. There's names we're definitely building that. What was something else I was just going to, oh yeah. No, that's not on the list. Moving on. Platinum, palladium. I think what is Russia the largest supplier of platinum and palladium? So Sprott, physical platinum and palladium, probably an asset you could buy. The thing is, it trades just like gold and silver, and I've got an overexposure to gold and silver right now. So I don't know if I need platinum and palladium, but if gold and silver are going up, this is going up with it. Yeah, so this is the Stillwater in the valley. Yeah, these things are all coming off of their highs a bit, RPR. That's not a symbol I know. But PRP. No. All right. How about Cliffs? Yeah, I mean, I don't own the steel stocks. Maybe I should. But here's the problem I've got with steel stocks. It takes nickel to make steel. Nickel's going berserk. They can't even open it again on the London Metal Exchange. They're trying to settle out prices. So I'm just very concerned about buying companies that make an end product where the raw materials going in are skyrocketing at a rate that makes it impossible for them to keep up. Like, can they jack up the price of steel fast enough to make up for the margin squeeze that's going on? That's why I stay away from these names. I'm never going to know that. All right. PDBC. This was a dividend distribution. Okay, thanks for that. Didn't know that. I have to do some work here. I don't know exactly what these guys are doing, so hard for me to make a recommendation or even a thought on it. Commodity-linked futures and other financial instruments. I don't. The dividend is a 40% distribution. I don't even understand that. So I'd have to understand the asset better. I can't do anything about it right now. I mean, if you own it, it looks great. I don't know if I have thoughts on this. Is geopolitical thoughts. I don't know if I can really add any value when it comes to geopolitical investments, right? I don't know what's going to happen next. So short China makes sense, but that feels like a FOMO trade, right? Like everybody's just kind of piling into it because they think, the next country to do something horrific is going to be China taking over Taiwan. Like I just can't, that's not investing to me. This market's very difficult because of all the geopolitical cross currents. And what I don't want to do is get carried away investing in something that doesn't really have a core. It's just emotion. It's just pure emotion. SJP pays monthly. Is it it's not a SJT is it's a royalty trust. It's a royalty trust. It's a really interesting idea for a market that we're in. Yeah, it's going to lag behind. Okay, the best place to have money in the beginning of a massive bull market in commodities, particularly gold and silver, are the big four gold companies that we own: Newmont, Barrick, Franco-Nevada, Wheaton Precious Metals, which also has silver. Then I'm going to buy some of the big silver stocks that are in the silver ETFs, like AG we own. Okay, maybe Hecla. I love Hecla. Okay. But when it comes to these secondary names, it's very hard to make money in an illiquid small cap name when small cap stocks are imploding. Okay. So I do like NFGC. I'm not saying you can't own it. I'm just saying understand what it is you own. The stock could break down because the market's imploded and then reverse and skyrocket. So you kind of put this thing away if you want to own it, and you make a position size where you can stand the risk, and then you just walk away and wake up one day and the thing's up huge because we're in a massive bull market in gold and silver. Yeah, it's so funny, Richard. We've traded this on the live trading desk more than once. We bought it in. This right here was a negative hit piece. Remember that in the short sellers? That was just to shake it out so they could buy more of the stock before it skyrocketed. Then they came out with another hit piece, which just rehashed this hit piece. And I said to you guys, hey, now's the time to buy MP right after the hit piece. Okay. But it is a little bit wide and ragged, the chart pattern. And if you, Richard, honestly, if you like the idea because of the rare earths, I think this is a better investment. It's a uranium company with rare earth as part of their process. So I really liked it. The quad U. That's kind of my favorite way to play it. All right, ladies and gentlemen, I have appreciated the time that you've spent with me. And I say to you, hit the like button if you've enjoyed it. I appreciate your time. Have a great weekend. I'll see all ARMR Insiders 8:30 for the morning meeting. Don't forget, you can subscribe to this channel. You can subscribe to the free ARMR action alerts. Just go to our website, click on it. You'll get our action alerts. You'll be able to see a replay of the morning meeting before the bell rings. All of you, please remember, the risk monitor's red. It's a negative gamma environment. Now's the time to protect capital first, and we'll capture upside when the window opens. You all have a great weekend, okay?